Supply and demand is one of the most powerful concepts in smart money concepts, but many traders still use it the wrong way. They draw weak zones, enter too early, and fail to understand why price respects some areas while ignoring others. In this masterclass, you will learn how to separate supply and demand from traditional support and resistance, identify high-probability institutional zones, understand why price returns to them, and execute trades using market structure, fair value gaps, mitigation blocks, breaker blocks, and multi-time frame analysis. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Let's start with the basics, understanding support and resistance. Support and resistance are zones where the price has reacted previously and may react again in the future. On the chart, you can see the price pushing up, hitting a certain area, and reversing. This area is known as resistance, indicating that sellers have initiated short positions while buyers have closed their long positions, causing the price to reverse. Similarly, when the price pushes down, hits a particular area, and reverses, it creates a support zone. This indicates sellers closing their short positions and buyers opening long positions, which causes the price to reverse from this area. Next, let's discuss why we should mark these zones on the chart. Here are 3 crucial reasons. First, levels where the price has previously reacted are likely to be rejected again, so we observe these levels closely for potential rejection. This helps set profit targets, especially if they are key levels on higher time frames, as even minor reactions here can lead to major reversals in lower time frames. Second, determining market direction. When the price breaks through a resistance level, it shows that buyers have overpowered sellers, indicating bullish momentum and a potential upward continuation. Similarly, breaking below a support level indicates bearish momentum, so we align our trades with the dominant trend. Identifying the direction is the first step when we open the candlestick chart. Third, identifying liquidity. We know that when the price reaches support and resistance levels, price action traders seek trading opportunities. Break and retest traders will buy if they see rejection signs in the zone, placing their stops below this level, anticipating upward continuation. If there isn't enough liquidity to push the price higher, the market might break below this level, grab the liquidity, and continue rising. So having our entry below this level can provide double confirmation of the moves we anticipate. Traditional support and resistance are also considered liquidity areas. Now let's explore supply and demand in smart money concepts. Supply and demand areas form when smart money enters the market, causing significant price movements. A demand zone is not considered valid when it is formed only by multiple small candle rejections, but a valid demand zone is confirmed by large candles indicating strong buying pressure. A demand zone cannot be identified when multiple small candle rejections occur, but a valid demand zone is confirmed by large candles indicating strong buying pressure. These momentum candles suggest the presence of large institutions, banks, and hedge funds, essentially the smart money in the market. Similarly, a valid supply zone forms when there's aggressive bearish momentum. So how do we gauge the aggressiveness of price movements? By identifying fair value gaps on the chart. We won't go into detail here on how to perfectly identify a fair value gap of 3 or 4 candles, as we have a specific and detailed video on this topic. I invite you to watch that video for a deeper understanding. Continuing on, the larger the gap, the more aggressive the movement, indicating an imbalance between buyers and sellers and the entry of significant money into the market. Typically, prices revisit these areas to fill orders left behind, restoring balance. Another key factor in validating a supply or demand area is the break of a structural level to confirm momentum, providing crucial insights for making informed trading decisions. If you're not familiar with market structure concepts, check out our previous videos on the topic. The links are in the description. Next, let's discuss how to draw supply and demand zones on the chart. Let's start with the basics. Identify fair value gaps and breaks on the chart. When we find a move with these criteria, we mark the demand zone by drawing a rectangle from the high to the low of the last candle that created the fair value gap. The same applies to bearish scenarios, regardless of the candle's color. Mark the last candle that created the fair value gap as the supply zone. Traders have various methods to mark these zones, but the key point is to place your stop loss in a safe position to protect against market fluctuations. And keep this in mind, whether I call it the last candle before the gap, the origin of the expansion, or the order block, it is always the same thing, the candle or candles that started the impulsive move that broke structure. We classify supply and demand zones into 3 types based on market structure: order blocks, order flows, and consolidation areas. Order blocks are optimized supply and demand areas with aggressive buying and clear fair value gaps, leading to a break of structure. The latest candle creating the fair value gaps is marked, and the liquidity sweep below this candle is noted before the price takes off. When placing a buy limit at this order block, the stop loss should be below the wick where the movement started, incorporating this area into the order block zone. As the price corrects, we enter positions when trading opportunities arise. If the last candle creates inefficiency, we place the stop above the swing high for protection, expanding our trading zone and stop. Sometimes, order blocks form with opposite colored candles in the midst of heavy movement, utilized by institutions and big players to fill remaining orders. We consider these order blocks and look for trading opportunities upon the price's return to these levels. Next, let's discuss the second type of supply and demand zone, order flow. Order flow represents areas where buying or selling pressure built up before an aggressive market movement. The bullish order flow is where the last bearish pressure occurred before the bullish move, and vice versa for bearish order flow. These areas are crucial in smart money concepts. For example, a move creating fair value gaps and breaking structure includes the last bearish momentum before a drastic move, forming a large zone often containing an order block. Monitoring market structure closely is vital for optimal trade execution. Finally, consolidation areas are key supply and demand zones. These occur when buyers and sellers lack the strength to drive the market into a trend, causing the price to oscillate within a range. Liquidity accumulates, potentially leading to a breakout. Consolidation zones become crucial supply or demand areas for traders, provided there is an imbalance. For instance, if the price consolidates during the Asian session and London liquidity enters, this consolidation zone becomes an ideal demand zone for long opportunities. The stop is protected above the zone, with multiple targets set. Similar to order flow areas, consolidation zones can be large, requiring careful trade entry to avoid an extensive stop loss. At this point, you may wonder why price reacts to a demand zone and what drives this behavior psychologically. The explanation is straightforward. In a bullish context, there comes a moment when buying pressure is no longer sufficient to keep pushing price higher, so the market naturally retraces. As price pulls back, it searches for opposing orders to absorb. And while filling the unfilled demand left behind, a shift occurs that leads to a corrective move lower. What truly gives these zones their strength is the fact that they are not random support levels. They represent areas where institutional participants previously entered long positions. These are decisional zones, formed before large orders were fully executed. Because of this, they carry significant importance. When price returns to these areas, institutions often re-enter the market to protect or reinforce their positions. Another important factor is that institutions do not deploy their full position at once. Instead, they build positions progressively, usually in multiple phases, especially around areas where their earlier activity is visible. This means part of their original orders remained unfilled during the initial move. When price revisits the zone, it offers a new opportunity to complete those orders. That is precisely why we wait for price to return to these areas. The same reasoning applies in reverse when dealing with supply zones. Now let us step back and look at the broader structure. Everything unfolds through four main phases: the base, the expansion, which can be either a rally or a sell-off, the retracement with mitigation, and finally, the continuation. And this is the most important part. Our attention is always on the continuation phase, because that is where the highest probability trade opportunities appear. This approach is built around two time frames. A higher time frame is used to assess overall market conditions and locate high-quality supply and demand zones. A lower time frame is then used to refine confirmation and execute precise entries. The combinations I recommend are the 1 hour with the 5-minute or the 4 hour with the 15-minute. You can apply other pairs as well, but the main rule is that your higher time frame must always be at least 2 levels above your execution time frame. Also, remember that supply and demand zones marked on the 4-hour and 1-hour charts are significantly more reliable, and price tends to respect them more consistently. With that in mind, let us now go into the mechanics of this setup and walk through how trades are executed step by step. In a bullish environment, the first requirement is to confirm that the market is trending higher and that buyers remain in control. This confirmation comes from identifying at least 2 consecutive bullish breaks of structure. Once this condition is met, focus on the most recent bullish break of structure. From there, trace price back to the starting point of the bullish expansion, the move that caused the break. That origin is what defines the demand zone. The next step is to mark the most recent unmitigated demand zone on the higher time frame and patiently wait for price to return to it. When price revisits that area, drop down to a lower time frame, such as the 15-minute or 5-minute chart, and watch carefully for reversal signals. This reaction provides your initial confirmation before considering any entry. That confirmation can appear as a market structure shift or a clear change of character. Either one represents your first layer of validation. This shift in market structure indicates that the short-term bearish move is losing strength and that bullish momentum is likely to resume. At this stage, price is expected to realign with the direction of the higher time frame trend. Once bullish structure is confirmed and continuation to the upside becomes the expectation, the focus then turns to finding a long entry. At this point, there are 3 different entry techniques available to open a position, in this case, a buy. Each approach comes with its own advantages and limitations. These include the classic fair value gap model, the mitigation block, and the breaker block. All of these areas tend to behave like magnets, pulling price back into them before the next upward continuation. In the first entry approach, after price reacts to the higher time frame supply or demand zone and creates a market structure shift on the lower time frame, we then look for a bullish fair value gap that forms within the structure shift leg. This becomes the zone for executing the buy on the lower time frame. For profit targets, you can aim for the closest liquidity pool on the current time frame or target key higher time frame levels if your objective is a larger move. In the second entry approach, once price revisits the higher time frame supply or demand zone, the formation of a mitigation block on the lower time frame presents a strong opportunity to enter a long trade. For a bullish mitigation block to develop, price must first form a swing low, followed by a swing high, and then a higher low. From there, price should produce a bullish displacement that closes above the prior swing high, creating a market structure shift. In this situation, the bullish mitigation block is defined by the up-close candle, or a series of up-close candles that appear between the initial swing low and the first swing high. To enter a long position, you can place a buy limit at the highest point of the mitigation block and wait for price to return and activate the order. It's important to note that this differs from a breaker block setup because breaker blocks require the formation of a lower low rather than a higher low. In the third entry method, the focus shifts to identifying a bullish breaker block inside the higher time frame supply or demand zone. For a breaker block to be considered valid, price must first create a swing low, then a swing high, followed by a lower low. After this sequence, an aggressive expansion in the opposite direction should occur, producing a market structure shift. In this case, the up-close candle, or series of up-close candles, located between the first swing low and the swing high, defines the breaker block. This is the area used to execute a long entry. The very same principles apply to bearish entry models, just mirrored in the opposite direction. Now, let us walk through this setup using a real market example to see how everything comes together. On the screen, we have the Euro-Dollar 4-hour chart. As you can see, price is in a clear and well-defined downtrend, with sellers firmly in control. The market has already produced multiple bearish breaks of structure, clearly more than 2, which confirms that the expectation remains to the downside. Because of that, our focus should be on identifying short trade opportunities. The most recent bearish break of structure is located here. If we trace that move back to its origin, we can identify an unmitigated supply zone. In this case, the 3 consecutive up-close candles at the start of the bearish expansion define that supply area. This gives us a fresh supply zone, and this is precisely the zone we want to pay attention to, since it represents an ideal location to look for short entries if price retraces into it. The next step is straightforward. We simply wait for price to return to this 4-hour unmitigated supply zone. Now, let us continue unfolding the chart and see how price reacts from this level. As you can see, price moved higher and tapped directly into the 4-hour supply zone. At this point, all the conditions we were waiting for are aligned. We have a strong downtrend with multiple bearish breaks of structure, a clear break of structure on the 4-hour chart, and a fresh, unmitigated supply zone at the extreme that has now been revisited by price. With everything in place, the next step is to drop down to the 15-minute time frame to observe price behavior inside the 4-hour supply zone and locate a precise short entry. On the 15-minute chart, we can see that after price tapped into the higher time frame supply, it reversed and formed a clear market structure shift. At the same time, a breaker block developed, marked by these 2 down-close candles. Pay attention to the sequence. Price initially created a swing high, then a swing low, followed by a higher high. Shortly after that, price sharply reversed and closed below those down-closed candles. This price action confirms the breaker block and adds a strong layer of confluence for entering a short position. With these confirmations aligned, we can reasonably expect price to revisit the breaker block area before continuing its move towards sell-side liquidity. So here's the execution plan. The entry is placed at the lowest point of the breaker block, with the stop loss positioned a few pips above the higher high. The take profit is set at the sell-side liquidity below the recent swing low, which results in an approximate 4-to-1 risk-to-reward ratio. Now let us continue playing the chart and observe how the trade develops. As shown, the order was activated. After a short drawdown, price reversed direction, moved lower, and ultimately reached the take profit level, exactly as anticipated. That first example shows how a higher time frame supply zone can hand you a clean short the moment lower time frame confirmation appears. But real trading is rarely that simple. So let's raise the level and take this same logic into a more advanced case study, one that combines supply and demand, fair value gaps, trade management, partial profits, and the exact moment when buying is no longer the smart move. And in this one, I'll also show you the notation I use while trading live. So let's start with a quick note on the letter P. Before we begin, one important detail is why I use the letter P in some market structure markings, such as possible change of character, possible high, or possible higher high. The purpose is to make the structure easier to read visually, especially for beginner traders learning market structure in real time. These markings help identify where a potential change of character or break of structure may happen before confirmation. This is especially important during live trading because price is constantly developing. A possible high or possible higher high is not fully confirmed yet because price may continue moving higher before a retracement forms. That is why we continuously track the structure and update where the current possible high is forming until the retracement confirms the move. And with that understanding in place, we can now begin analyzing the chart step by step and follow how the market structure develops in real time. In this example, we will be using the Euro-USD pair in the Forex market, analyzing both the 4-hour and 1-hour time frames throughout the entire setup. Let's begin by opening the 4-hour chart to identify the key zones and understand the broader market context. In this case, we have marked two important order blocks, one demand zone order block and one supply zone order block. Since price is currently trading inside the 4-hour demand zone, the next step is to move down to the 1-hour chart and look for a possible structural shift that could provide a high probability trading opportunity. On the 1-hour chart, we begin marking the key areas and identifying important points such as the lower high, lower low, the possible break of structure, the potential bullish reversal, and the buy-side and sell-side liquidity zones. The main objective here is to determine whether the market is starting to shift direction inside the higher time frame demand zone, which could provide a strong and valid trading setup. As price continues developing on the 1-hour chart, we begin to see early signs of reversal. The market closes near the lower high and surpasses it with a wick, creating a possible bullish structural shift. However, this transition in market structure is not fully confirmed yet. Confirmation will only happen later, with another wick above the lower high, or with a candle close above that level. At this point, we can also begin marking the fair value gaps forming on the chart, since these areas may later become important execution zones if the structural reversal is fully confirmed. On the following candle, price once again creates a wick above the lower high, confirming the bullish transition in structure. With the reversal now confirmed, we can begin marking the new low and identifying the possible high forming on the chart. Now that the structure is confirmed, we can map the Fibonacci retracement and identify where the premium and discount zones begin to form. As we can see, the fair value gap is positioned around the premium zone, which will become our primary execution area for this strategy. Now, you might expect us to buy only in discount, but in this model, the fair value gap itself is the execution trigger. When the imbalance sits in premium after a confirmed structural shift, we let the gap, not the equilibrium, define the entry. Before opening any position, the most important thing is to fully understand the logic behind the setup, the execution area, and the risk management model that will be used throughout the trade. For this fair value gap setup, the stop loss will be based on the size of the fair value gap itself. The entry will be positioned around the 0.382 Fibonacci retracement level, and the trade will be managed using two separate targets. The first objective will be placed at a 1-to-2 risk-to-reward ratio, where 50% of the position will be closed. The final target will be placed at a 1-to-3 risk-to-reward ratio, where the remaining 50% of the position will be closed. Once the stop loss and both targets are positioned, we can see price retracing directly into the setup and beginning to move toward the first objective at 1-to-2. As soon as that level is reached, 50% of the position is closed, and the stop loss is immediately moved to the entry point. This is one of the most important parts of the strategy, because once half of the position is closed at the first objective, the trade has already secured profit. Since only 50% of the position remains open and the stop loss has been moved, there is no longer any possibility of turning the overall setup into a losing trade. Even if price reverses after this point, the profit already secured from the first partial close guarantees a positive outcome on the overall position. After securing the partial profit, price continues moving higher and eventually reaches the final target at 1 to 3, closing the remaining 50% of the position. One very important and interesting point regarding this strategy is that price is still trading within a bullish trend and has not yet reached the 4-hour supply zone. Because of that, the market still has room to continue developing to the upside. As the next candles begin to form, we can see price retracing back into the demand area before creating another bullish movement higher and breaking structure once again. During this new impulsive move, price forms two fair value gaps, giving us a completely new structure to analyze. At this point, we begin marking the new trading range by identifying the low and the possible high, while also marking the key areas where a potential break of structure or a possible bearish reversal may occur later in the development. From there, we execute the strategy once again following the exact same process and risk management model used previously. In this specific case, since two fair value gaps were formed during the bullish movement, we will position the order at the beginning of the second fair value gap, which is located closer to the 0.382 Fibonacci retracement zone. Because of that positioning, the first fair value gap, the one located higher on the chart, may potentially act as an inducement zone before price moves deeper into the second fair value gap and fills the intended entry. Once the strategy and orders are positioned, we can observe the next price movements developing on the chart. The following bearish candle retraces into the beginning of the second fair value gap, reaches our planned execution zone, and then quickly reacts to the upside. From that point, price moves directly toward the first objective at a 1 to 2 risk-to-reward ratio. As soon as that level is reached, 50% of the position is closed, and the stop loss is moved to the entry point, securing partial profit and protecting the overall trade. After the first target is completed, we continue monitoring the next price movements while allowing the remaining portion of the trade to develop naturally. As bullish momentum continues, price eventually reaches the final objective at a 1 to 3 risk-to-reward ratio, where the remaining 50% of the position is closed, fully completing the setup with another successful trade. One important point to understand at this stage is that price has now reached the 4-hour supply zone. From this moment forward, it is no longer ideal to continue looking for long positions, because the market is now trading inside a higher time frame area where selling pressure carries significantly more weight. When price reaches a major supply zone on the 4-hour chart, the overall upside potential becomes much more limited, and the risk to reward for additional buy positions starts to decrease substantially. This happens because the sellers operating on the higher time frame have far greater influence over price movement than the buyers operating only on the 1-hour chart. In other words, even if the 1-hour structure still appears bullish for a short period of time, the market is now approaching a region where higher time frame participants may begin defending positions and pushing price lower. And this is where the market dynamic begins to change completely. In the following candles, buyers gradually lose control while higher time frame sellers begin stepping into the market aggressively. As we can see, price starts dropping sharply from the supply zone, creating a clear bearish structural shift and confirming that momentum is now transitioning to the downside. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.